I'm Angel Manteslaras and welcome back to the 6th episode of the Forex Trading, the Foundation class. In this episode, we will learn how to compare the economic fundamental status between two countries and how to translate this into a trade. Without further ado, let's begin. Fundamental analysis is the study of the economic conditions of a country to determine the intrinsic value of its currency. This involves looking at economic indicators, monetary policy, and other economic information of national importance. In the previous episodes, we studied each individually. Now, we will combine all of the information we have gathered and compare it to another country to see which currency will rise in value and which will fall. Now that I have briefed you all on what to do, let's fill up the data for January 2022. Economic indicators are found on the economic calendar website, while the monetary policy statement has to be read individually. Sadly, there is no single website we can go to determine which monetary policy a central bank is implementing and the rationale behind this. However, there are websites that show the present interest rate of each country and the schedule of the next update. It is preferred that you update this table daily before you make any trade. If you don't trade on a daily basis, just make sure to refer to this table first. The number one mistake most beginners do is trading without analyzing. Remember, fundamental analysis tells you which currencies to buy and which currencies to sell. Technical analysis tells you what price to buy and what price to sell. Although you may trade purely due to fundamental or technical basis alone, it is risky, especially to newbies. Based on personal experience, it is best to trade with all fundamental, technical, and sentiment analysis in consideration. I will quickly fill up this tab and then show you the next step. I have some points to explain. 1. In regards to USD, you can see that some data is unavailable. It means the US government, central bank, and private organizations are not collecting this kind of data. So, we just have to make do of what is out there. 2. You may notice that in the case of GDP and CPI, I included various frequencies simply because countries are releasing these data in different frequencies. In the US, only quarterly and year-on-year GDP is available, while CPI has month-on-month and year-on-year versions. If time is not specified, it means the data is released on a month-on-month basis. 3. Actual figures have three colors, black, green, and red. This is synonymous to how economic calendars, such as forexfactory.com, presents the actual figure. Black in color means the actual is the same as forecast. Green in color stands for actual, better than forecast, and red expresses actual is worse than the forecast. Since this table only shows actual figures, having color codes like this reminds me of how the actual data performed against the expectation. This is important because the rise and fall of a currency do not only rely on actual versus previous. When trading in a lower time frame such as M5, actual versus forecast holds more weight. 4. I have categorized economic data based on categories used on popular economic calendars as well, so there is no confusion on your end. 5. The month specified here is the release date, not the time frame the data is referring to. For example, this retail sales was released in the month of January, but it is referring to the retail sales for the month of December. Of course, it has to end first before we can calculate the data. I opt to do this instead of the actual time frame the data is gathered from because we trade based on the newest information available. And 6. This form of analysis is only applicable if you are trading on H1 time frame or higher. If you are trading on a lower time frame than H1, use the economic indicators and news of the day for guidance. Looking at column C, it appears the US growth is performing, but the retail sales disappoint. Especially this figure is pertaining to the month of December, where the holiday season plays a huge part in consumer spending. On the other hand, inflation is high at 0.5% month-on-month and 7% year-on-year. There are less jobs created than forecasted, but the unemployment rate has fallen to 3.9%. Consumer and business surveys are showing signs of weaknesses but still good overall. The housing market, on the other hand, is getting stronger consistently since last year. Looking at this information, I know the US is performing well. However, in trading, we buy one thing and sell the other one. So, in order for me to know what trade I should do, I have to analyze both economies individually and then compare them. As beginners, it is advisable to stick to the major pairs first and slowly learn to trade the cross pairs. So the next popular currency after the dollar is the euro. Hence, we will compare the US and EU data and come up with the Euro-USD trade. As mentioned earlier, fundamental analysis tells us which currency to buy and which currency to sell. Meaning, on this kind of analysis, we will not be able to tell the price of our trade entry or exit yet. In order to make a clean and clear comparison between the dollar and the euro, I created a separate tab showing just these two. The first category is growth. Both the US and the euro area do not have a monthly GDP, but releases both quarterly and annual GDP. However, the release months are different, hence, if there is no release data for the month, I will be referring to the most recent data available. So for the month of January, the US quarterly GDP was 2.3%, while there is no release for the euro. The most recent data for the euro was last December, hence I will be comparing it to the previous, which is 2.2%. As for the annual GDP, the US has 5.7%, while the euro area has 3.7% from the month of December 2021. The US has a better figure for both quarterly and annual GDP. Moving forward, the retail sales, just like the GDP, only quarterly and annual frequencies are available for both currencies. The euro area has a better monthly retail sales at 1%, while the US has a better year-on-year retail sales at an amazing 16.95%. It is hard to compare the core retail sales as the euro area does not collect this data. Nonetheless, the negative 2.3 core retail sales from the US does not sit well. Pertaining to this data alone, I will give the euro the advantage as both data were better than forecast and previews. Both the US and euro area trade balance disappoints. Both are expected to improve, but both came out lower than the forecast and previews. I can't say the euro trade balance is better simply because negative 1.5 billion is smaller than negative 80.2 billion. You have to note that there is a huge GDP nominal value difference between these two. If you really need to know which one performs better than the other, you have to put into consideration the percentage of how much the trade balance is in comparison to its GDP. As a beginner, this is too much work and not very important either. So, for the meantime, let us say neither has an advantage over the other. Next is industrial production. The euro area monthly industrial production performs better at 2.3%, but the US year-on-year is better at 3.67%. Nonetheless, the monthly frequency has more weight in comparison to the annual, so this is a point for the euro. Lastly, the euro area does not collect durable goods orders, so there's no comparison here. In general, in regards to the growth aspect, the euro has the advantage. Next category is inflation. In both CPI and core CPI, the US is seeing faster inflation versus the euro area. Although the euro area PPI is faster in the US, the CPI holds more weight than the PPI because the rise in production cost is usually carried on by the consumers. Since the US is experiencing faster inflation compared to the euro area, expect the Fed to be more aggressive in raising the rates than the ECB. Third category is employment. It's quite tricky to make a comparison for this aspect as the US only has NFP and the euro area only has employment change. The only data we can objectively compare is the unemployment rate. The clear winner in this area is the US. The 3.9% is good given the forecast and previews are 4.1 and 4.2% respectively. In regard to the housing market, the US has better figures as well at 373.45. Moving on to business surveys, the Euro area has better manufacturing PMI and business sentiment, while the US has better services PMI and business confidence. Since the US has higher figures, the US has a slight advantage here. The US has an advantage as well in terms of consumer survey and 10-year bonds. Since both the Federal Reserve System and the European Central Bank did not change the direction of their respective interest rates, had similar risk, and move a step towards tighter asset purchases, both of them has the same point for this aspect. In summary, the Euro area has an advantage in terms of growth, while the US has an advantage in regards to inflation, employment, housing market, and business surveys. Since both monetary policy statements echoed similar concerns and actions, the US is a clear winner in regards to the entire fundamental analysis. The biggest factor here is the fact that the US is experiencing higher inflation and has a bigger tendency to apply a tighter monetary policy. Let us take a look at the US and Euro currency index. As we all can see, the US is stronger than the Euro index in general. Hence, in summary, the appropriate trade is Euro USD buy. Let's check the pair. The fall of the euro against the dollar started on January 14th. This is the week the US CPI, PPI, and retail sales were released to the public. As mentioned in previous sessions, central bank mandates include maintaining inflation at 2% and keeping the unemployment rate low. I am not seeing any issue with the current employment rate, so the main focus for now is the inflation rate. Since the inflation rate is persistently staying above the 2% target, and the US is experiencing higher inflation than the Euro area, it is most likely that the Fed will be more aggressive than the ECB in raising the rates, both in the number of rate hikes and the basis point increases. Hence, the US dollar will have more value than the euro. Since technical analysis tells us what price to trade, fundamental analysis can provide a small insight on what day to trade. Let us go back to the chart. After the release of the inflation data in the second week of January, the only thing of importance on the economic calendar are the PMIs on January 24 and the Fed funds rate on January 27. So based on my personal experience, this is what I will do. I will sell Euro USD on January 17. Question: why January 17 when the inflation was out on January 12? This kind of analysis we're doing is not applicable for short-term trade. This is only applicable for swing trading. The time frame we trade is H4 to D1. H1 can be used if we zoom out a bit. Swing trades usually last for several weeks to months. Hence, we are taking quite some time to analyze because our trade requires time as well. So if you're doing some short-term trades, you only need to consider what is currently happening. Thus, it will require fast decision making. When doing swing trades, personally speaking, I dislike to enter the market in the middle of the week or just before the trading week closes. So the rationale behind this is that a lot can happen during the weekend. Remember, we retail traders cannot trade during the weekends. There is literally nothing we can do when something important happens during the weekends. Last reason is that Friday is a quote-unquote take profit day. There are traders who only like their trades to last within the week, so from Monday to Friday only. They will enter a trade sometime within the week. So in the event their trade did not hit either take profit or stop loss before the market closes, they will manually close their trade. It doesn't matter whether it is winning or losing. This is done because these traders feel uneasy leaving a trade open during the weekend. As they say, a new week is a new trade. Personally speaking, I had a bad experience opening a trade on a Friday and leaving it open during the weekend. I remember trading USD JPY on an NFP Friday. So I was making money and I left it because, well, it's profiting. But something happened during the weekend. As far as I remember, Kim Jong-un of North Korea tested some missiles over the weekend, so causing the USD JPY to react in the opposite direction of my trade. Being a stubborn newbie, this happened to me several times before I fully learned my mistake. Let's do another example. Still Euro USD but for the month of February 2022. No GDP data for both the US and EU area, so let's move to retail sales. The US 3.8% is clearly better than EU's negative 3%. The US annual retail sales is also better. The Euro area does not release core retail sales, but the US version without a comparison is still great. Despite both trade balance on a negative, the US has an advantage because the actual is better than the forecast. Both areas have better than forecast monthly industrial production, but 1.4% is better than 1.2%. Again, the EU area does not collect durable goods orders, so we have no comparison here. Overall, US has a score for the growth category. As for employment, the 467,000 NFP from the US is great, but the unemployment has risen from 3.9% to 4%. Not a good move, especially the Euro unemployment rate has fallen from 7.2% to 7%. The US unemployment claims and job openings have risen too. Seems a pretty close comparison, but let's give this round to the Euro area. As for the housing market, the US wins at 367.77. In terms of business and confidence surveys, the US stands at a better ground. Both the US and EU area have a lower manufacturing PMI than last month, but the US actual is better than the forecast, so there is a slight relief there. The EU services PMI disappoints, while the business confidence is better than previous and forecast. EU consumer sentiment is as is, while the US consumer confidence and sentiment are both better than expectations. As for other indicators, the US has an advantage as well, since the US 10-year bond performs better than the German 10-year bond. The dropping German stock market, aka DAX 40, or before it was known as DAX 30, traditionally will help the euro find some footing on its value. I will explain this more in the next chapter and also the next episode, intermarket correlation. Lastly, the monetary policy. There is a movement from the ECB, but there was no meeting from the FOMC side. Hence, let us just compare the February ECB monetary policy statement versus the January Fed monetary policy statement. Comparing the ECB December and the February statement, not much has changed except for the risk involved. The ECB has its eyes on inflation and geopolitical tension coming from Ukraine-Russian war. It also continued its move on tightening its monetary policy by lowering the pace of the PEPP and APP. So comparing the US January and EU February monetary policy, it seems both central banks are moving towards the same steps and are worrying about the same things. As of the moment, neither has an advantage over the other in terms of monetary policy. In summary, the US stands better in terms of growth, inflation, housing market, businesses and consumer surveys, and other economic indicators, while the ECB has a slightly healthier employment data. Overall, the US fundamentals for the month of February 2022 is one step ahead of the euro area. Let's take a look at the DXY and EXY. Now, for the month of February 2022, both indices closed near the price where they opened. Looking at the Euro USD, the currency pair closed near the monthly opening price as well. So assuming we entered the trade last January, I think it will not hit stop loss yet. But if you're a very conservative trader, you would have placed a partial take profit at 1.113 area where the January low is located and a second take profit at around 1.078. I will not explain the reason behind these prices yet as this is part of the technical analysis which we will discuss in the latter episodes. So for the activity on this episode, I want you guys to collect all the economic indicators from the US and Euro area for the month of March 2022 and tell whether to buy or sell Euro USD or probably avoid it. Pause this video or mark where this part is so you can come back once you're ready to answer. Okay, let's begin to answer together. Both the US and Euro area saw an improvement in its GDP data. Although there is a huge jump from 2.3% to 6.9% for the US GDP, this number is slightly lower than the 7.1% forecast and 7.2% preliminary GDP collected from last month. However, both annual GDPs are the same as forecasted. This is a tricky figure to compare, but let us take a look at it this way. If we are trading short term, the euro should be better given it is as expected. However, if we trade in the medium term, the dollar should perform better because it has observed a higher GDP figure. As mentioned during the first example we did earlier, this kind of analysis we're doing is applicable only to swing trades, aka medium term. Hence, in this sense, the USD beat the euro in this indicator. Next is retail sales. So month-on-month data disappoints, but 0.3% is higher than 0.2%. So also, the US annual retail sales has improved versus last month and is the same as forecast. So the US has a better retail sales as well. Both the US and the euro have seen their respective trade balances swimming further to the negative territory. The former fell $9 billion more, while the latter fell 22.6 billion euros more. However, the US trade balance fell lower than the consensus. So as explained earlier, the US data is still seen as the better one given we're trading on a medium term. Next, both monthly industrial production is the same as forecast. But as for the annual frequency, the EU number has fallen sharply in contrast to its 1.6% data last month. Again, the US outdid the euro area. So in a nutshell, the US performed better than the euro area in terms of growth. Following growth is inflation. So both territories have seen their respective CPI, core CPI, and PPI go higher than last month. Since both monthly figures are as expected, I will switch my attention to the annual frequency. As observed last month, the US is still experiencing faster inflation than the euro area. Surely, 7.9% and 6.4% are harder to bring back to 2% than 5.9% and 2.7%. However, the euro area is experiencing higher PPI at an astonishing 5.2 and 30.6%. So allow me to give you some context here. The Ukraine-Russian war has already begun. So both countries are major suppliers for the EU area. Ukraine is a major supplier of food while Russia is a major supplier of energy in Europe. So since these two countries are engulfed in the war, the supply chain is greatly affected. It is impossible to replace this much supply overnight, but the demand is still as is. So many producers are either struggling to find raw materials for their products, and that since they are exerting more time and money procuring supplies, they need to increase their prices, or some are simply raising their prices while playing the low supply, high demand game. Although the war affected everyone as there was suddenly a huge vacuum on the supply chain, Europe's proximity and dependence on Russia and Ukraine is greater than the US, so they will be affected more. Bottom line, the US still wins this round. Next is employment. Although the euro unemployment rate has fallen, the US NFP and unemployment rate is simply amazing. America definitely has a stronger labor market. This is also true in regards to the housing market. The US housing index is consistently growing for the past months. As for business surveys, although the US manufacturing PMI slipped, the rest has improved in comparison to last month. On the other hand, all euro area business surveys missed the forecast. On top of this, both business confidence and sentiment has fallen. Given this situation, this round is $40 as well. In terms of consumer survey, the U.S. consumer confidence has increased once again to 107.2, while the sentiment fell to 59.4. Nonetheless, 59.4 is still a very good figure. Meanwhile, the Euro consumer confidence fell once again to negative 21.7. Hence, the U.S. performs better again on these criteria. For market data, the U.S. 10-year bond is strong at 2.325%, so is S&P 500. For most part, currency and the stock market have an opposite relationship, but in this case, both are rising. This only means money is coming into the U.S. because its economy is strong. Looking at the monetary policy, the Fed had already started raising its rates while the ECB is still stagnant. So no doubt, the dollar should perform better than the euro. Let's look at the currency indices. Let us confirm our analysis. The DXY has broken the previous month high and has stabilized above that area, while the EXY slipped to a new low. Finally, let's check Euro USD. It is mimicking the performance of the DXY and has settled below the February low. From the technical perspective, it seems to be forming a correction after a huge drop from February. That's the end of the fundamental analysis chapter. Remember, if you are trading on a short-term basis, let's say M5, use the economic indicators and the news of the day to guide your trade direction. If you're trading on H1 or higher, make sure to follow through the steps that we did on this episode before making any decision. A higher time frame trade requires more patience and analysis, while a short-term trade requires quick decision making. Trade on a time frame that suits you best. Dun-dun-dun! So in the next chapter, we will discuss the relationship of each asset class and how we can apply that in Forex trading. I will see you next week. Bye!